And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And good morning. Welcome to Financial Fitness Podcast. We're so glad you're here. Well, Brent's glad you're here. I'm never really glad about anything. Well, I am sort of glad. I'm glad. Okay, I changed my mind. I'm glad you're here. You know, in this crazy world that we live in, which nothing surprises me anymore, sometimes you got to go back, look inside yourself, and realize there are certain rules and tenets you live by. And those rules can save you many times. And I'm not talking about money, just the way your philosophy of life and rules that you follow, rules of the road that you know work for you to keep you sane, keep you happy, keep you even keeled in a world that's very turbulent. And sometimes you can take that world and put it into markets and money. You can move that over. And everything we do at RIA is rules-based. So yeah, we can get distressed emotionally when we see markets more turbulent. I never trust markets, and you shouldn't. They can change on you very quickly. Never be overconfident, right? There's a rule that I always follow, that I've always followed, even though I study this stuff, and I always know that I can learn more. And I always know the market can turn around and cut me at the knees at any time. That keeps you aware. That allows you to shift gears and make moves that are better and not emotionally based. So everything we do. So I created these financial guardrails. And financial guardrails are these timeless principles for building wealth and keeping it. And some of them you're not going to agree with. And I don't care, frankly, because you're going to have your own. And some you're going to agree with and some you will. And that's the beauty of disagreement and discussion, right? But these are rules I also have learned from the wealthiest of people who started with nothing and had a perspective and worked with it. And I took it and put it all together. And I wanted you to understand it. And again, frankly, you're going to agree with some of these, and some you might say, well, you know, there are exceptions to every rule. We don't live in the outliers. We live in the main, right? Outliers are definitely possible, but for the most part, I think you'll find that these guardrails make a lot of sense. So the other day, some dear clients of mine, they're in their 80s, getting sold an annuity. These people have built a wonderful wealth, more than many of us will see in multiple lifetimes. And they are very down-to-earth, great people. And they got sold an annuity for 7 figures. And the beauty of a fiduciary is to look at things objectively. And I wondered, why in heck do these people need an annuity? So the first rule is annuities should be planned, not sold. And the worst thing about annuities are people who sell annuities. There's nothing wrong with the product. They're sold not in the best interest of the consumer. They promote certain things or not, or look to sell annuities without knowing your full financial picture. How the heck do you know if I need a lifetime income stream? Or have I generate more income now that, say, for example, say you generate more income now than you ever did even when you were working. Why do I need an annuity? And why do I need to put so much in it at 80 years old? So I said, I don't think this is a good idea. And person says, well, you know, if you want to find an annuity that you want to offer us, we'll look at that. And I said, I don't want to offer you an annuity. You don't need an annuity, and it's not appropriate. All right, and that's the beauty of being a fiduciary. Now, they're probably going to do it anyway, and that's okay. But at least I did my job. So the smartest way is to understand if an annuity is appropriate is determine whether the total wealth you've accumulated, that you're investing, your Social Security and or pensions and other liquid assets can sustain your household spending throughout retirement. If there's a shortfall, an annuity structure could be effective, right? Social Security is an annuity, right? Annuity is not a four-letter word. Well, the way they probably teach it in public schools, since they can't spell, it probably is. So you want to partner with a fiduciary to decide. And some people will come to us and say, do I need an annuity? And my first answer is, I don't know. I have no idea. I don't have any idea. If you're going to figure out or find out that you're going to run out of income, remember what annuities are. Generally speaking, the actual core nature. They're generators of lifetime income. They are mitigation against longevity risk. And I know you all know when you're going to die. You all know it, right? You have that. It's your little crystal ball. It's your little magic 8-ball. My parents died. Listen, my parents died at 50 and 59. And most of it was their lifestyle. Okay? Which would have exhausted you, Hefner. I don't live that lifestyle. I never smoked. I never have taken one drug that's not been prescribed to me. And even then, I don't like taking them. So I was not in that part. So I have already outlived both of them. And there are people and members in my family that have lived in their 80s and 90s. So a lot of it's lifestyle. So if I was looking at living to 100, or I was doing some of my blood diagnostics, and I realized, listen, especially a man who lives to age 65, I'm not 65, but a man who lives to age 65 has leapt a hurdle. So longevity risk needs to be protected against. Annuities, like a pension and Social Security, are good ways to do it. So if you're going to run out of money, then an annuity could work. Then you got to look at when you're going to purchase the annuity, what type of annuity. And it's not the only thing that annuities do. Annuities are the DNA of guaranteed income. But for example, for full disclosure, I own fixed indexed annuities instead of bonds. I ladder them because I want the greater potential that I can get with some stock participation, but I don't want the downside risk. And there's a paper that we have written about that, and that's in there, and that comes off the work of Roger Ibbotson, who said that, yes, could you use fixed indexed annuities that are participating in some form of return of an index, market index, with no downside risk as maybe a bond replacement. And it's absolutely feasible. So the first guardrail is annuities have to be planned, not sold. So if someone is trying to sell you an annuity, my rule is you walk away, because how the heck do you know my whole situation? Yeah, you know my tax bracket, kind of risk I'm looking to take. You know certain things to cover your butt. But you have no idea what assets I have, what income generation assets I have. So keep in mind, guardrail 1, annuities should be planned, not sold. And annuities are not bad things as much as Ken Fisher rails against them. Not many people have the bajillions of dollars that Ken Fisher. I am pretty sure Elon Musk doesn't need an annuity for income. I'm sure there are trusts and other things that are going to protect him from creditors and when he says crazy stuff. But what I'm saying, the last thing he needs is some form of guaranteed income structure. Right? So keep that in mind. Guardrail 2. Everybody wants a house. Everybody thinks that's the American dream. And Lance will tell you, it's not. The American dream is to build something or grow something, generate wealth that you can buy a home and secure a home. But a home is nothing but an expense. Guardrail 2, consider a primary residence as a place to reside, not an investment. In reality, depending on the mortgage outstanding, it's more a liability than an asset. Heck, we don't even own your house when you pay it off here after property taxes, right, Brett? You would think that, oh, yeah, I own my home. Yeah, do you? So you want to calculate your return from a primary residence. I had an aunt that I work with. She lived in Deer Park, New York, and she goes, I'm the one to sell my house. And I put it in, and I helped her years ago with this. And she bought this house in Deer Park for like $20,000. And that was a lot of money. And she has some property there in New York. And she sold it for like $150,000 after like 35 years or something like that. And I did the return calculation for her. Because you have to look at, I have to track improvements, add back the purchase. I look at my cost basis. What did I buy? Taxes, maintenance, everything that goes into that home has to go into the return figure. All she knows is she paid $20,000 and she got back $125,000. So she's making money. But when I told her her return was about 2.7%, well, she didn't like that very much. I said, if you just sort of taken that money and put it into like ExxonMobil or shut up. Now, there are exceptions, right? Depending on the location, overall supply and demand, uniqueness of your property, right? But these are not typical homeowners experience. Most people live in homes that look just like the home next to them. They live in these cookie cutter developments. Listen, it's not like taking your money and throwing it away. You did buy an asset. But just because you paid so much for it doesn't make it an investment. It's not generating anything for you. Now, if I'm looking at residences to rent, to create an income stream, totally different. But your primary investment overall in your home is not an investment. So if you think of your house as a place to reside and not an investment, it'll help you just keep your perspective and not become house poor, right? Another one, and we have seen this, and I love this one. We have seen more adult parents taking care of their children, adult children, and sacrificing their own goals. Retirement, whatever they had, they are supporting their adult children at levels we have never really seen. We have more multi-families living together than we have seen since World War II. So even today, we have clients that'll come to me and say, oh yeah, my son's asking for money again. My daughter's asking for money again. And we allow a certain amount of that in a plan. But 3 is never allow others to cross your personal financial boundaries. And this is a tough lesson. There's nothing inappropriate about maintaining boundaries and saying no to obligations that may place your personal financial security in jeopardy. So we witness parents who extend themselves to co-sign for children. We know those who lent family members only to be disappointed. Loan obligations are not met. My own personal rule is if I'm going to give you or I'm going to loan you money, I'm not loaning you money. I'm gifting you money. If you decide to pay me back, that's all well and good, but I don't want to ruin a relationship with somebody that I like or I care about because they decided that they're not going to pay me back. Money destroys a lot of great relationships. So it's best to understand up front the financial impact of your personal situation. Know your boundaries and stick to them. So some people, what they'll do, I'm going to give to my mom. I'm going to give to my kids every year. Okay. We'll just put that in your financial plan. We know every year your kids are going to get $5,000 or $3,000. But it fits within your plan. It's not breaching your boundaries. It's just another goal that fits. And yes, there's an opportunity cost of money you could have done, but if that makes you feel better, you want to pay for your grandchildren's education, you have the money to do so, God bless you, do it. But you know when you're being used. And sometimes you need to hear that from an outside source, like your financial advisor, who sees the pattern for what it is and finally approaches the client and says, there's a problem here. So number 3, never allow others to cross your personal financial boundaries. Number 4, create your own financial rules around debt control and savings, then stick to them no matter what. Right? And I'm going to lay you out some of our rules, and you're going to hate them. And if you want to share this podcast with your kids and grandkids, don't give them my address because they're going to put poopy bags outside my door. But if you look at excessive debt and limited ability to buffer against financial emergencies, well, then you are never going to be able to take on riskier ventures that are actually going to grow your wealth. One of the best rules, and we say this all the time, and financial services never update their rules, and most of them stink. But paying yourself first is one of the best ones out there. If that's the only one you take away, you've won the game. Money into savings before anything else. I started that with a paper route before I was even 12 years old, and I have never stopped. So here are our guardrails. Let me know what you think about debt guardrails. Mortgage debt. Your primary residence mortgage, 2 times your gross salary. That means if you make $100,000, you should not have more than $200,000 worth of mortgage debt. If you make $500,000, it's no more than $1 million. That doesn't mean you should take on the $1 million. And your realtor will tell you, you can take on $4 million. Never tell your realtor exactly what you make, because then that realtor is going to try to fit that money or that earning power into a bigger home. And we know what comes with a bigger home. Bigger nuisances. That doesn't mean that you can't find a 3,000, 4,000 square foot home that, because you have family and you got other, you got elderly parents moving in. I get all that. What I'm saying is there may be a stage in your life where you're not really willing to do that. So don't be swayed. 2 times your gross salary. Student loan debt. I took on student loan debt. This is a rule I created. I limited it to 1 year's worth of total expenses, tuition, room and board. I could allocate it how I wish. So when I was in college, and it was much easier to get a loan and interest rates were lower because you didn't have the government interfering with all of it, as they do today, I took out, I want to say $20,000 to $22,000 and used it over a 4-year period. I put some of it away and then I stationed it out. So if I'm taking on more than 1 year's worth of student loan debt, I have to look at the ROI on that college degree. My gender studies degree won't mean crap. My sociology degree, not going to mean much, especially today. Look at what's going on with AI. Look at corporate job freeze. Look at how many companies are letting white-collar workers go because you don't need them. Entry-level jobs are one of the most challenging areas for young college students to get into today. Look at your degree as an ROI. What kind of return on investment am I going to get depending on how much I'm putting in? I was going for a finance degree with a minor in marketing, and I figured $20,000 over 4 years, maybe 5 with a graduate degree, was probably fair. I would have been able to recoup that. And college was more affordable. Personal unsecured debt, credit card, auto debt, no more than 25% of your gross monthly household income. So figure out what your gross income is. No more than 25% in unsecured debt. Okay? And you want to be below that number. Unlike a bank that'll tell you, these metrics, the kinds of metrics they use is to get you into a debt. The metrics I'm providing you is to keep you out of it or minimize it. It's totally different. Well, the bank says I could do X times this and whatever. Yeah, X times this to make your house poor. That's not the job here. The job is to free up money so you invest that money to create wealth and have opportunities to do so. Or when an emergency comes along, you don't have to load up credit cards and not pay them back or pay them off in full. So remember, there's a difference. Guardrail 5, absolutely crucial today. Invest in yourself. Human capital is a measure of the economic value of an individual's skill set. A passion to learn is going to increase your ability to earn. I've always believed that. I've always believed that for as long as I can remember. Lifetime earnings are your financial fuel that drives wealth and savings. So you want to boost or learn new skills that increase your value in the workplace, right? Facilitate sort of an entrepreneurial kind of venture. You have to maximize the return on you. So let's put it in perspective. 30 years earnings, current median household salary is roughly $59,000. An individual or family would earn $1,780,000 over a lifetime. Yeah, the goal could be to double that median income every decade. But that comes from focus, determination, and a little bit of luck. Never stop reinventing or learning because it will affect your pockets. Guardrail 6. Good health is a significant contributor to financial and physical wellness in retirement. HealthView Services did a report provider. They do cost projection software. Healthcare costs in retirement are rising twice as fast as the typical annual increase in Social Security benefits. As a matter of fact, there's a lot of talk right now that the consumer price index that is used for Social Security is inappropriate. It should be CPI-E, not CPI-U. E for elderly, sorry. That may be a derogatory term, but the goal is to look at how does an older household spend versus a younger. What kind of inflation do they have versus you? Remember, inflation is very personal. Your household's inflation is going to be very different than mine across the board, depending on children, what stage of life, your health. So if you look at out of total pocket spending for an average 65-year-old couple retiring today could exceed $400,000 when Medicare premiums, supplemental insurance, and deductibles are included. With a 5.5% HealthView annual increase in healthcare costs, we're roughly in our planning software at 6% for the increase. So you want to be cognizant of what you're eating and your lifestyle and the exercise you're doing to increase the quality of your life. So these guardrails are not just about money. They're investing in you, which creates wealth or a quality of wealth. They should not run Sydney Sweeney ads while I'm doing this. It's very distracting. Thank you, Brent. It's been 7 minutes of Sydney Sweeney on Fox, and I can't think of anything else at this point. All right. Guardrail 7. Don't think of Sydney Sweeney. No. Realistic return projections, time horizons, and inflation factors are crucial to successful planning. If you go to a broker and they run this software, most likely they have not tweaked it. It's right out of the box. So if I'm using historical returns for investments, man, you should probably be able to retire yesterday. But due to valuations, we know that over the next 10 to 15 years, returns may not be what you think. That has to be in your plan. Okay? Listen, financial planning is far from perfect. You're working with projected returns on risk assets, estimating how long a person may live, where inflation may be at the time of retirement, an intelligent guessing game at best. So this plan is a snapshot of your progress toward these financial life benchmarks that you have. So studies show that people who actually have a financial plan are more successful than those who don't. But the common pitfalls you're going to place are in the planning systems. Overly optimistic outcomes, which we've seen, with asset return projections and life expectancies that may be far from what you'll experience in the real world. So why? Why are financial plans so rosy? Because they're designed to sell product. You can't get to where you're going without this JP Morgan, Charles Schwab product. Maybe you can, if I'm realistic in my planning. So what you want to do is, if you run a plan with someone who's not a fiduciary, or you want to understand the guts of the plan, and I always say, listen, a lot of times I don't want to know how the sausage is made. Just serve it to me, put some mustard on it. I don't want to know. You want to know with the financial plan. You want to know, how did you get these asset class returns that you're using? Are you using returns over the last 10 years, which have been amazing? Or are you looking forward using some form of formula or rule? How are you studying inflation? What sources do you utilize to track inflation per goal? Are you letting the software do it? Are you checking it? You're using that I'm going to be living to 135,000 years old because that's as much, because you want to sell me stocks, and that's the only thing, that's the magical formula. But do you know anything about my health? Do you give me any kind of diagnostic that gives me some idea? So, ultimately, a second opinion of a completed plan, and always seek someone who's, I think, a certified financial planner who's also a fiduciary. So that's the rule. Realistic return projections and inflation. 8, be vigilant of confirmation, recency bias, and other emotions when it comes to financial decisions. Listen, money is so emotional, it's impossible to avoid mixing feelings and finances. But you have to recognize these cognitive and emotional biases as much as possible. Last week's podcast, I think, was, with Jonathan, we talked about our investor profile. That's looking at risk capacity and other things that point out where you're going to stumble, either in a very aggressive bull market or a very volatile or bear market. So you have to know. So just to give you a little bit of background here, bulls and bears are myopic in their perspectives. So at Real Investment Advice, we look at the view from greater altitudes. Thus the eagle, right? Where's my eagle? Oh. Thus the eagle, because the eagle soars above. You'll ponder from above portfolio and financial decisions. Let those bulls and bears fight it out. I want the ability to change my mind. I want the ability to look at things at a very different level and from a holistic mindset. Frankly, again, I like financial media. I'm sort of addicted to it. CNBC, Fox Business, Bloomberg. I like it. It's like my pablum. Like, it's got to be on at all times. And it drives a lot of people crazy. I'm sure it drives the dogs crazy. But, I'll have Fox Business on in the bedroom, CNBC on in the living room. It's a thing. Because I want to hear what they're talking about. Not because I want to follow the advice. I want to know what kind of questions I'm going to get from everybody. How many times are they talking about NVIDIA? How many times are they talking about this? AI, whatever. Gold is the next big thing. Who's pushing their books? Why are they pushing them? I want to know that. But I'm not going to take action on any of it. So pundits that are employed by big box retailers, especially, and financial media celebrities, they don't want you to remember 2008. They don't want you to remember 2000. They don't want you to remember 2022. They don't want you to remember that. It's just that everything is great. So, and when are the pros really held accountable? Yeah, poor Elaine Garzarelli, look her up. She was held accountable. But a lot of times not. And it's very easy to get sucked into a current phase. Like this one. And listen, AI has lots of benefits. You know, it's going to add to the bottom line. You know, I read transcripts from various companies. I listen to what CFOs and CEOs say. I know it's impacting jobs, and I know what they're looking to do. But my thought is, after you let so many people go, the more AI you use, the more people you're going to hire. And I know that sounds strange. But the more sophisticated the AI gets, the deeper I want to go with it, the more expertise. So talk about increasing your human capital. What an opportunity you have as a young person to embrace this and capitalize on it. Because my thought is, you'll lean and mean for a while, but then sooner or later, the more AI you're on, it's like your house. You have one AC system, maybe two. What if I had 50? What if I had 100? I can't have just one HVAC person. AI requires maintenance. AI requires teaching for maximization of productivity. These people are being overconfident, and they're going to have to restaff with people who have these skills to handle the AI wild horse in the corral. And you could be that person. So remember that everything changes. Whatever's happened over the last 5 days does not dictate the next 10. You have to avoid these biases. Your advisor can help you. The tools they use can help you very much. Guardrail 9. Create a household financial wellness evolution. So when you look at financial wellness, it's consistent monetary success and pathos, which leads to security and generates inner peace. And wellness ebbs and flows depending upon what goes on in your household. So let me ask you a question. You need to come up with $5,000. And a lot of households can't come up with $500. But you need to come up with $5,000 because you need to replace an engine in your car. And you can't really afford a new one. But now you're stressing out. My financial wellness, my overall feeling of wellness has gone to zero. It's sitting in a ball in my gut. If I had an emergency reserve of $10,000, yeah, I hate the fact that I got to spend $5,000 on an engine, but I've got it. And I breathe a sigh of relief. Oh my gosh. You know, I hate to pay it, but I've got the money. Thank you. There's a wellness factor in there. You just probably added a year to your life. So you want to look at what wellness is. Listen, it's not pretty, but there's beauty in the consistency that you follow to bolster your certain financial situation overall. And these financial decisions you make over a lifetime not only forge your path, but also the road you take into the future. And it could flow through to multiple generations long after you're gone. So it's worth understanding that money, your actions, how you treat it, is much bigger than one individual. Think about that example I gave you. $5,000 out of my account. I never forgot that I had that $5,000 to put that engine in my car. Now it's 15 years later, and I have children, and I'm talking to them, I cannot tell you the importance of having a cash emergency reserve. Let me tell you a story. Never get that feeling that, oh my gosh, I don't have the money for this. An emergency that comes up. And you teach that child paying yourself first and creating an emergency reserve. If that's the only thing you teach that child, and that goes from one generation to the next, you've accomplished a lot. So these guardrails are things that I've learned. I have conducted myself throughout history of my life. And I am sure if you sit down this weekend, and again, you can download the ebook about financial guardrails at realinvestmentadvice.com, right? Look up to resources, type in financial survival guides. We will be renaming them ebooks, but tape them, and we have a whole bunch of them on a whole lot of topics that Lance and I wrote about. And this is one of them. And I would share this, especially around holiday time. Look at this guide that my advisors wrote. Follow these guardrails as best you can. It could be the best gift you give them, and it won't cost you a thing to download it off the site. Well, I don't know. These seem to be running. I seem to be in the 30 to 36, around the 36-minute mark for these podcasts. Not enough to make me angry, just enough to keep me calm and sanguine. But I'm glad you're here. I hope you get at least, if you take one of these guardrails and put them to work, let me know, because I want to talk about it in future podcasts. Hope you have a great rest of your week, everyone. Thanks for tuning in to Financial Fitness Podcast. RealInvestmentAdvice.com. Get Lance's newsletter. We write every day. Read it, share it, love it. Well, at least like it. We like you. Thank you.